Welcome back to the Real Estate Momentum Podcast. My name is Aaron Smith, and I'm here with a very special guest who I connected really well with. His name's Sean Cohen with S. Cohen Insurance. What's up, brother?
How's it going?
Good. We just spent a few minutes talking about his Tesla trade. I don't know if you traded or not, but it got into the whole tech conversation with the cars, and then we got into talking about real estate investing. So you guys are in for a awesome show. We're going to talk about stuff that is for everybody right now, whether you own a home or a car or both. And then we're going to get into some stuff for real estate investors. And then we're going to talk about something very special that I'm learning about right now that Sean knows a lot more about than me. And it's called infinite banking. We're going to learn a little bit more about that. So let's get right into it. So what do you do on a daily basis as an insurance broker?
Wow.
What's your daily go-to?
Do they call it running a business because it's running, right? That's what I feel like. As any business owner, like you and many others, I wear a lot of hats. So a lot of it is just people. And whether it's dealing with phone calls for claims or people wanting to shop their insurance or employees wanting to, like, what do I do? What do I need to do? What about this? What about that? And
how many phone calls do you think you get in a day? It's a lot, right?
It doesn't stop.
I know.
Like, it doesn't stop. I know we have over 3,000 customers, and there's no slow time for us.
And when they call you, they need you.
Yeah, they're
not just calling to say, "What's up, Sean? How you doing today?" They're like, "Dude, I got something's going on. I need you." So, and you're kind of like their saving grace, right?
They need a call.
Yeah.
They need an answer.
So let's go into some examples that might help my friends here who are watching or listening. A lot of times I get the phone call of, do I call my insurance company for this or whatever? The last call I got was somebody who was asking about, I think we had a really heavy rain. And I said, man, like, I don't know, like, you're going to need to call your insurance agent on this thing, but I think if it's falling water, it's covered in most people's policies. Like if your roof's leaking or something like that, if the water's coming from the ground, that's a whole different animal. So let's open up that for a second so that, let's say that somebody who's watching this has a finished basement and they want to make sure that if there is some sort of groundwater leak or some sort of leak that they're covered. Let's open that up. What's that look like?
You opened up a can of worms. Speaking of open up, that's
I figured.
There's two claims I see more often than anything: water, wind, and hail. So those are two of the most often claims. And if you got that water backup, that's a lot of times coming up, and you want to make sure that's covered. If you back to the question about calling your insurance agent, the original thing, one of the many things that you want to make sure you do is, first of all, have an independent insurance agent where you can call somebody and just have that conversation.
Yeah, that is a huge value because when you're calling a 1-800 number and you've never talked to this person before, there's no compassion there whatsoever. If you're my insurance agent and I call you, you're like, oh my gosh, is everybody okay? If you care about the customer instead of just filing a claim or whatever.
Well, if you call that 800 number, boom, your claim's open. You have a claim on your claims history. As soon as you call that 800 number, they have to and are trained to open a claim. If you call your independent insurance agent, they are going to say, well, here is how I read the policy, and you may want to open the claim, you may not. I'm not going to tell you one way or another, but here's the facts about how it is and what it plays out to. Because there's another circumstance. I remember hearing about another one of my policyholders just posted on social media, hey, I think our windows are leaking or water's coming in. And well, insurance policies aren't meant to be a maintenance policy. If there's like caulking that's dried up around there or something in that nature, like the seal's not, it has to be a covered peril, which means like a storm or a fire or a wind, those types of things, to be able to interact that. With the sewer backup, like that's a covered peril where the sewer backs up. Now you got to have that additional endorsement, which most people do these days because there's been too many horror stories not to. But the newest thing is the underground service line coverage, where the tree root grows through those old pipes, and having that covered. I've had a lot of people that are surprised when we place that coverage on there. A lot of people don't know that that's available to them.
So typically, when you get wind, hail, fire, most homeowners insurance policies for a single family residence that you or I might live in, that's going to have wind, fire, hail, stuff like that, right?
Yep.
As far as I walk down in the basement, my basement's leaking. That's something I have to ask you about, like, hey, can you put this on there? Same thing with sewer line.
Yep.
Might ask for that. Hey, just in case, how much is it going to cost me to add sewer on there? It's only this much. Like, you know what? I want to sleep better at night. Let's just put that on there. And then you got service line. Sewer is where it takes out all the garbage, right? It takes out all the waste from your house. The service line is what brings the water into the house, correct?
And both of them can be covered in the sense of you have the backup, which covers the damage from the backup, and then you have the actual sewer line itself underneath the ground. So you have the coverage for the stuff underneath the ground, and then you have the coverage for the backup of that.
Do you find it to be a common mistake where somebody does home improvement, they forget to call you and tell you like, hey, we just finished our basement, or we just added X, Y, and Z onto our house, or we fixed this up, and then they might end up in a situation where they're undercovered now? Like they just increase the value of their house or the rebuild cost if something happens due to wind, fire, hail, or whatever, and now they're not going to have full replacement value because you didn't know about it.
Yeah, part of the policy language on most of the time, what policies are reading right now is what's called guaranteed replacement cost. So it's guaranteed to be replaced, but you also have to contact the insurance carrier, let them know that you made that update to your basement, or you made the update to your windows, and you have a higher replacement cost. Because if initially when you go over that policy with them, they price it with vinyl windows and an unfinished basement, you upgrade it to wood windows and a finished basement, they're still pricing it with the vinyl. Whether or not they may stick to their guns on it or not, probably not, but it's you better not have to fight that fight if you don't want to.
You ever seen the show Mythbusters?
Yeah.
You want to play Mythbusters really quick?
Oh no.
All right. So one of the things that we hear a lot of times is that your homeowner's insurance doesn't cover your water heater, it doesn't cover your mechanicals, it doesn't cover any of that stuff, and that's why a lot of companies that like home warranty companies like, well, your insurance company isn't going to cover you for this, so you need a home warranty to cover you for these things. And a home warranty is a very valuable thing to have when you need it, right? Heating and air goes out, water heater goes out, you got coverage, make the call, gets fixed, it's nice. What is the truth when it comes to homeowners insurance or insurance that could help with that?
So how do they do a Mythbuster?
I don't know. They probably big red X comes up on the screen or something like that. So
it can. More carriers are adding more coverages as things get more competitive. Just like in any industry, they're looking for new ways to be able to cover things. Like you mentioned, surface water the other day. Or just a couple minutes ago, rather, that can be covered now. Surface water coming in can be covered now. You got the equipment breakdown. You can have that added, but those are all things that you need to ask about. If you don't know, you don't ask. Nobody tells you. Just stick you with the policy, whatever the cheapest thing. I just want the cheapest thing there is. I hear that sometimes.
Well, I mean, there's a lot of times when people are buying houses, they're like, hey, give me the highest deductible you can give me. Just get me into the house, because your insurance plan is going to go to your lender, and your lender's going to bake that into your mortgage payment with principal, interest, taxes, and insurance just to get you into the house. If you don't fix that stuff, you're going to be underinsured, so that when the hail, the rain, the fire, the whatever happens comes along, and now your deductible is $36,000 on your house because you just wanted a low premium to get into the house, it's like, well, that's going to come back and bite you. So that's something we kind of talked about right before we got started. Is like people are like, they squeeze themselves into a low premium, but they don't realize when the fit hits the shan, so to speak, they're going to end up with a big bill, and they're not going to be able to put a new roof on their house because their deductible's so high.
Never do a percentage deductible. I can't preach it enough, because what happens is you mentioned the changes on the house. Well, also what happens with your insurance policy is that your home inflation, they have this inflation guard that builds it up, and every year that dwelling keeps going up every year. And what happens with that is the percentage of that dwelling is the deductible, so that goes up as well. So as you may start with a $300,000 house, and 10 years later it's a $500,000 house. You had a $3,000 deductible, now you have a $5,000 deductible, right. And you have a wind claim, and then you have to pay a $5,000 deductible on it.
So to finish up our game of Mythbusters for you people who are a little obsessive compulsive about tying up loose ends, it is not true that your insurance company can't help you out on mechanical stuff. So ask your insurance provider. Call Sean. We'll have his contact information in the podcast notes and in the video. So call Sean. Make sure that you ask your insurance agent, hey, what would it cost me to add mechanical coverage to my insurance policy? Am I covered for backup? Would you say backup?
Sewer backup, underground service line.
Underground service line, sewer backup, and then I guess is there like a water intrusion kind of coverage as well?
There's like a extended water, surface water, that can act somewhat like a flood policy.
Yeah.
So that if, like, especially on those basement garages where you have those underneath where that water would just go flowing right in there, those things would be covered in those circumstances.
Yeah, and it's really hard to kind of give you guys numbers on what this stuff's going to cost. Everything's different. There's a big it depends on everything. It depends on how old the house is and where the house is at and all this stuff. So we're not going to get into that. But the main thing is just know your insurance agent. It's very important to have an independent insurance agent that you can pick up the phone, have a good relationship with, and call Sean and just say, hey, what do I need to know about this? So I selfishly here, we've been talking about houses the whole time, right? Because that's my business, but you also do auto coverage. We talked a little bit before we got started today on how auto insurance rates are changing.
Yeah. In general, it's what us insurance agents call hard market. And everyone's seeing a lot more rate increases and things are increasing. And we've seen it. The number one complaint I got for years was my car's another year older. I have no claims. Why does my auto insurance keep going up? Well, cars are getting more expensive to fix. There's all these sensors in them. We talked about Teslas the other day or today, and they're just getting more. The frequency of accidents are more. The severity of accidents are a little bit more too. So you're paying for all the insurance. So if you want, you can find ways to either shop it every 3 to 5 years. There's companies out there that we have access to that may be able to lock your rate in. If you don't change a policy, it's not going to change. Yep. So especially for people in that 50 to 65 or greater, they're not changing a whole lot. They've kind of like made their moves and they're ready to downsize, or they're ready to kind of just steady Eddie, and they want to keep things the same.
And for those of you who we talked the other day, this insurance is not a sexy topic, right? It's like nobody just goes out there and like, you know what, I need to buy some insurance today. I think I'd like to have a little bit more insurance. It's not that sort of thing, but it's all necessary. So here's an analogy that I always tell people when it comes to insurance on why rates change the way that they do, right? So when I need to fly to California, I get on board an airplane, not with just myself and a pilot. I want to share the cost of that air flight with everybody who's on board this airplane. We're going to go to the same place, right? If I had to pay for that flight myself, I couldn't afford it. When I go to buy a house in a homeowners association, I'm sharing the cost of maintaining the neighborhood, the pool, and all that stuff with all the other homeowners that are in the area. An insurance company is very similar, where I'm going to pay into this thing so that if something happens and I need to use it, everybody else who's paid into it also gets to help me with my claim. And then eventually somebody else is going to have a claim, and you get to use part of my co-op money that I've put into my insurance company to fix their stuff. It's the same thing. Well, as costs of construction go up, costs of auto accidents and things like that go up, rates are going to go up.
Yeah.
So that's just kind of why that stuff happens, right?
Yeah.
A lot of times when somebody goes to apply for new insurance policy or get a quote on something, they ask, what's your credit score?
Yeah.
Or you get a credit score thing. How might that impact somebody?
It's one of the biggest factors. There's certain states that are getting away from that, like Washington State will no longer, because you get somebody moving in from another country, necessarily they don't have any credit, so it's not really fair assessment in some ways. So they're trying to figure out what to do with that, but it does show responsibility. And then ultimately, like you were saying about you're sharing in a pool of risk with people. Do you want to be sharing in some pool of risk with somebody that's had 4 DUIs and they're driving recklessly 150 miles an hour, whatever it may be? Like, I don't want to be paying for their insurance.
Yeah, it makes rates go up, right?
Yeah, so you want to find responsible people, and the insurance carriers, they're going to charge for the premium that of responsible, and so they feel that
just
credit
the easiest way to find out how responsible is this person, right?
Somewhat,
Chances are somebody with an 850 credit score is not running around reckless and causing a lot of disruption.
They're a little more responsible, probably.
You would assume so.
What I call the bean counters, they have figured out, along with some other indicating factors of like trying to figure out how do you measure responsibility.
Right.
And
it's really hard. I mean, you can't judge a book by its cover, and credit score is just an indicator, right?
Mm-hmm.
So quickest one we can find. instead of calling in all their relatives and employers and everything and verifying how awesome of a person this is, right?
Yeah, scrolling their Facebook, seeing what they're posting, like Instagram and all that. So,
yep.
Yeah.
You want to switch gears for a second? Let's go into some real estate investing.
I love it.
All right. So one of the conversations that Sean and I had previously is about a group of folks that are super awesome. It's a group that we started back in 2016. It's the Northern Kentucky Real Estate Investors Network, I guess is what you would call it. And we've got a group on Facebook, and a lot of us share resources like, I need a drywaller, I need a contractor, but we also share things like, hey, who do you guys have your insurance through for your short-term rental or for your duplexes or your large multifamilies or things like that? One thing that Sean does is he also specializes in helping real estate investors. We had a good conversation earlier, so we're going to open that up, find out what real estate investors could do better, they could know more about. What comes to mind just in thinking about the real estate investors that you've worked with, and maybe some suggestions you've made for them that might be helpful for any of the investors watching right now?
Number one is having an independent insurance agent that you got a relationship with. You touched on it earlier. As a business owner, as an investor, you want to have a business relationship, and you can use that relationship to make a business case to get the best insurance at the best possible price. And a lot of people don't realize that you can work with your insurance agent to figure out how can we make this work. Is it going to be a multi-unit? If I make this update, is it going to affect the premium on a roof update perhaps? Or if you got a lot of people don't realize the mechanicals actually play an issue to it as well, and maybe using it as a bargaining chip, like, hey, this is not like, I need this up to date, I need that up to date, and you can use that leverage in negotiation a lot of times too. I've had people have roofs paid for a lot of times with, even when real estate, if the roofer goes out there and I have a roof that's 15 years old, I can't really shop it with anybody. Most of my carriers won't do anything. 15, 20 years. A lot of times you need that roofing updated. You can put that in there.
So as you're shopping as an investor, let's say we go look at a 4-unit apartment building. And apartment building A has all new windows, roof, HVAC, all that stuff. Yep. And that's gonna be a case on their insurance as far as hey, everything's updated here.
Yes.
And then you go apartment building B, and 4 gas furnaces that are 30 years old. The roof is box gutters have seen better days. The roof's in rough shape. Obviously, you're going to pay more of a premium because stuff's going to need to get fixed soon.
Exactly.
Why? Here's a question for you, and if you don't know the answer or can't say the answer, that's fine. But I find it strange that when I call my insurance company and get a quote on something, one of the first questions I get is, how old's the HVAC system? It's like, why does that come into play? It's a thing, like, right? You need to know that. And I'm like, why is that such a big thing? Is there a good answer for that? Or is that just something that just kind of gives you a litmus? Is it like the credit score of a house? It's like, how well has it been maintained and how updated is it?
It's a rating factor for multiple reasons. Everything with insurance, I feel like, is multiple reasons. The HVAC probably plays into, number one, is there the possibility of a fire? Number two, how much care and maintenance are they doing on the upkeep of the home as just a general upkeep, pride of ownership for that. And then also that mechanical equipment breakdown, that also comes into play as well. So the majority of it is number one is the safety risk. Like, is that furnace gonna, is it gonna cause a fire? Is there any dust or debris in there that's gonna, possibly cause any problems?
Okay. I never thought about that.
And then is it the mechanical breakdown? And then how much is the pride of ownership is my deduction from it.
I got you.
Yeah.
Okay. You hit something earlier that I don't know much about. We're sitting in the Valley Creek Farms model home in a builder's home here, and you mentioned builder's risk, and I don't know anything about it. So let's talk about that for investors and how they might use that.
Yeah, builder's risk. I get this call a lot, and it's usually when the bank wants it. The bank has to have it. The bank's like, okay, you're doing renovations, you have a construction loan, you're doing this much renovations. You need to have the builder's risk. And a lot of, especially early investors, don't understand builder's risk, but it is, we talked a little bit about general liability. It's the liability for all the people that you had, those subcontractors doing work on the property. While that general, if once something goes wrong, what ends up happening is everybody starts doing this. Oh, it was him. Oh, no, it was him. Oh, no, he left the lights on. Or no, he left the electrical box open, or whatever it is. That builder's risk takes on all the risk for the construction process. When you're opening up walls and you got the plumbing and you got, you're doing, you cause a sewer line break, you pressurize something wrong, whatever it may be. When you're doing those renovations, a lot can go wrong, whether it's from an oily rag or a nail gun through a water line.
Yeah, I don't know how many times I've heard it, but somebody leaves an oily rag out and it causes a fire while they're doing new construction. So this is for the investor. Maybe they bought a property at auction, or they bought a property somewhere, and they're gutting the house and they're putting new stuff in there. Builder's risk basically protects them for any of their contractors that are walking in and might slip, fall down the stairs, or
any work that
drop
they're
a hammer on their toe.
Yeah. And if you're opening up walls, you need to do builder's risk on it. That's to protect yourself. It may cost you a little bit extra, but in the long run, it definitely is going to protect you a lot better. And it's going to CYA for you. That's all it is. Is insurance is gonna. You don't want to use it, but you want to know it's there. It's all good until you have to use it, and that's when you really know.
Is that similar to a vacant property insurance? I know that it's tough to insure a vacant property. It's not tough. It's just more expensive, right? Yeah. There's more risk involved. There's nobody there to protect it. What happens if there's a water leak? There's nobody there to shut it off.
It's different because you have somebody actively working on it, and you are insuring the work, and you're insuring the risk of that construction. Where the vacant property, it's more of like the risk of the vacant property and something happening and nobody knowing about it.
Yeah. I got you. So another hot topic right now in the real estate investor community is short-term rental, and it's become more and more popular because the cash flows are just insanely high, right? It's a lot more work. It's less passive. When you have a short-term rental property and you've got people coming in 2 or 3 groups a week, and constant cleaning and laundry and buying toilet paper. I'm saying all this because I am a short-term rental owner, and I'm just thinking about all the griefs and hassles that are involved with it. But short-term rental insurance is way different than your long-term rental. What makes it different, and what's the best way to go about taking care of yourself as an investor there?
So when I'm dealing it from an insurance, I have short-term and long-term rentals, and I know what you mean there. So when I'm looking at it from an insurance perspective, if you have it as your prime, there's two boxes. You have your one, you're renting out your short-term rental as your primary home. That's, you just have an endorsement on your home policy. Most home carriers are doing that now because they know Airbnb, VRBO are covering the main thing. However, if you're direct booking, insurance carriers typically don't like it when you are handling your own direct bookings, because you're taking out the primary insurance carrier, being Airbnb and VRBO, for anything that may happen, parties, fires, whatever could happen there. That Airbnb, while it's under rental, is going to be covering that. Where you do a direct booking, your insurance carrier is the one picking up. There's no primary there. They are the primary. They don't mind being the excess carrier after Airbnb and VRBO, but when you do the direct booking, it creates a little bit of an issue. But if you have an investment property, then it becomes more of a commercial. It's a business then, and
right?
It's treated as a business, and you want to make sure that you have that. And also, like, one of the big things is make sure you got loss of income on anything that you do for a business, because if it's out for 6 months and you're out for 6 months, that, as we know from COVID, and that's a whole nother insurance thing that I wish that's a podcast by itself.
Right.
But that's, make sure you have that loss of income, and that you report that if you say you have this much revenue. It's where the other thing I see with investors is like, oh, I don't want to say I have this much revenue because it does affect the premium because of that loss of use. But you're out for 6 months because of a fire. That's your income.
Right.
So insurance policy will cover that loss of income. You just got to make sure you have it on there.
Yeah, and I know the city of Covington is either just coming out of a moratorium or they're about to come out of a moratorium. I'm not really sure where they're at with that. I know that we've not been granted access to open ours back up. So if we had loss of income, would that protect us from some sort of government like stoppage, or is that more like, hey, we had an issue here at the house. We had a roof leak, and it stopped us for a month because we had to get back in there and replace all this stuff, right?
It all comes back to what caused it.
Yeah.
So, like, in that, that's where the COVID thing happened. Like, what caused it? What was the direct loss is what the insurance carriers came back to every time. It's like, what is it? Was it a fire? Was it a wind? Was it one of those covered perils that you have on your policy? So it depends on the policy language of like what you have under that coverage. And that's the other thing, having what's called comprehensive peril or open peril. That means everything's covered unless it's excluded. And a named peril policy means this is covered. This is fire, wind, hail, vandalism, riot, civil commotion, all the like named perils. But having an open peril or a comprehensive peril means everything's covered unless it's excluded. So it depends on how the policy reads, and a lot of it is, like you said, what it is. Is it wind? Is it hail? Is it rain? Is it
somebody's
fire?
Laziness who didn't apply for the license in time?
No, that one.
Okay, all right. So I guess I'm not covered.
City officials being tough, like, and
Yeah.
I hear they make it kind of ridiculous.
Yeah, it's like we're not going to enforce it until now.
No.
We're going to enforce it. And it's like, well, damn, I guess I'm behind the eight ball. I shouldn't have waited. But whatever, right? So I want to get into the infinite banking, but first, commercial versus personal.
Okay.
As an investor, elevator pitch. What are we doing there with commercial policy versus should I have a personal policy when I buy it? A rental or whatever that might be.
It's like my old engineering professor said, gain something, lose something. There's pros and cons to both of them. Once you get into the commercial policies, there's a lot of advantages to having a commercial policy, especially if you have a lot of different units, like let's say doors. That's how we usually refer to them in the investment world. Once you got multiple doors, you really want to go into a commercial policy where you can start to sharpen up what that looks like for you as an investor. It will typically put it all into like a package for you. So you want to be conscientious of like how you're doing it, because if you want to have them separate, it's a little harder for bookkeeping, but it also it helps you to keep that premium lower and apply all the coverages. However, one claim affects the whole kit and caboodle. So again, there's pluses and minuses. If you do personal insurance on it, and personal insurance, will be able to insure anything up to a 4-unit typically. So once you get above a 4-unit, you typically have to go commercial anyway.
Kind of like with the financing, if it's if it's residential is 4 units and less, commercial's 5 units and more, kind of thing.
Yep, similar. Yeah, exactly. But let's say you got 20 single families. It might be beneficial for you to put it on a commercial policy, because let's say those are, let's just round numbers, $1,000 a piece, where you're paying $20,000 in premium, and you could have all 20 of them on a commercial policy for $10,000 at about half the cost, and save yourself a lot more money inside of there, and also make the business case of like, hey, I'm bringing all this over with everything that I have. What do we need to do to make this work? And okay, what do we have on the updates? Can we, do you want to do this? We can look at it, or if you want to separate them, you can separate them out. And then having multiple carriers, having that independent insurance agent that can look at different carriers, because every single carrier has different niches that they're good at.
Yeah. And so my suggestion for anybody who's got multiple rental properties or just one, doesn't matter. We all know that as an investor, it's gotten tougher with interest rates going up lately. If you want to free up some, let's call it capital, you want to cash flow a little bit differently, something like that. If you have a portfolio, whatever, give Sean a call your insurance agent and just say, hey, look, here, what would it look like if I wrapped all this into a commercial policy? Would that save me anything on a monthly premium? It doesn't hurt. I mean, I should probably shop.
Don't shit on yourself.
I should on myself, but I should probably, reach out to my insurance agent, or you, whoever that might be, annually, every 2 years, just to kind of like,
I say every 3 to 5 is usually a good rule of thumb. Because I mean, if I'm sitting there shopping every single person, and I do have one person that just does shopping for me, that's all they do. I say, go shop this, and that's all they do is shop it.
I got you.
That every 3 to 5. But if I was doing 3,000 households in every 2 years,
it's a lot.
Yeah, it would be.
But if they do it every 3 to 5 years, at least a homeowner or an investor is going to know I'm getting the best rates. I have the right coverage. I've made these updates to the house. I want to make sure I'm covered for that finished basement, or if I need to add a battery backup or a backup sump pump or something like that, that's going to save me money on my insurance. It's like, at least you're checking in with your insurance provider and you're not leaving money on the table.
If you think of safety, security, and updates in any of those circumstances, like if you're updating your home and you've either added improvement to it in a safety, security, or value wise, then you definitely want to contact your insurance agent, and don't feel like you're bothering them, because everybody doesn't want to. They feel like they don't want to talk to their insurance agent, but it's sometimes very helpful, and you may find out something you don't know.
Yeah, well, insurance is very similar of a business to real estate, where it's a relationship business. And that's why it's so important to have an independent agent, right? So I love it when a client that doesn't plan to use me to buy a house anytime soon gives me a call to ask me a question. It shows me, number one, that they value my opinion. And number two, it allows me to catch up with them and find out what's been going on in their life and all that stuff. So, Sean's 100% right. Don't feel like you're bothering your insurance agent. Just don't call him like every week. That's kind of weird. But
text.
Yeah, text him. Ask him for a picture of his nice new Tesla. So infinite banking, I'm highly curious because this is something that an investor or just the average Joe or Jane could use to leverage and kind of build wealth. So what the heck? What's this?
Oh man,
I know you're
should have
excited.
Started with this, man. I get so excited.
I gotta save the
it.
good stuff for the last. It's like the ice cream cake from Dairy Queen when you get to the little cookie stuff at the bottom. Like, it's the best part. So like, I saved it for last for you, man.
So good.
Yeah, let's go.
I get passionate about it because I hated life insurance when I first got into this industry. I'm like, I'll do auto and home. Life insurance is a scam. Like, I don't want anything to do with it.
Right.
And so then I was like, okay, I had kids. I need to get some term insurance, and I got some term insurance. And I kind of, Dave Ramsey, buy term, invest the rest. That's what everybody needs. And like, you do. Just, get some term insurance in case something happens. And, and then you don't. It's not a good investment. Don't invest in. Don't ever pitch it as investment. Then I came across this infinite banking. I didn't believe it. It took me 2 years to really wrap my head around it. And I'm like, I don't get it. It's kind of what was that maybe Jim Carrey, or no, it was Big with Tom Hanks.
Oh,
I don't get it. Like, I'm dating myself a little bit.
Yeah.
I don't understand. That's how I felt with infinite banking, because it takes a specialized nature of knowing how to structure it a certain way. You don't have to have, everyone thinks, I think you have to have a lot of money to be able to do it. There's 2 or 3 ways that it's really used a lot. One is for real estate. One is to purchase cars.
So start with this as if I'm 5 years old.
Okay.
I'm 5 years old.
Okay.
And explain it to me in 30 seconds or less.
All right. So you want to have a savings account.
Yep.
That earns more than 0.5% interest, and be able to use that savings account while keeping the money in the bank at the same time.
So I'm borrowing from my own money at a lower rate than what I would borrow from somewhere else. And I can take that money and go buy investment property with it. Mm-hmm. I can take that money and invest it in something else that's going to get me a higher rate of return than what I'm spending.
Yes, and you're going to continue to earn interest on that money while it sits in the bank. Let's call it.
So I've seen TikTok videos on this. I've seen, and it's highly interesting. I say that because when I see it, I'm like, oh, damn, that's a good idea.
Yeah, it is.
But I guess when you let's apply it, okay. Right? Let's have a case study here, I don't know, case study, not really a real case, but let's have a scenario.
So I'll use myself.
Okay.
I've done two transactions with it. Okay?
Perfect.
So in the first year taking out my policy, I had you mentioned buying real estate, and I went and I bought a piece of property. It needed a full renovation. So what did I do? I pulled $40,000 out of my cash value, borrowed against it at 4%, put it into the policy. I put it into the renovation, fully renovated everything in the house. Okay. Then I was planning on selling it, but back in October of last year, it flipped for me. I couldn't get anybody to bite on it.
Right.
So I decided to turn it into a rental. And that rental, now it's now renting for $1,500 a month. I take that, and I'm still earning 4% on that $40,000 that I took out of the policy at 4%. I'm paying it back at 4%. Now you get dividends on top of that every year. So those dividends earn interest as you're earning, and that interest is compounding. So like if I had 100,000, I only put 40,000, I'd still be earning 4% on the 100,000.
Gotcha.
Okay?
So on a whole life policy, I know like you can get a term life policy for like, I don't know,
$30 a month.
Oh my gosh, it's cheap.
$20 a month.
Especially if you're young and healthy.
Oh my goodness.
You can get a
$10 a month.
I mean, it's dirt cheap, and you croak, it pays off your cars and houses or whatever else it covers. But a whole life policy, it's a little bit more expensive.
It is.
Because you can use it as this investment kind of vehicle you can borrow. It's got more bells and whistles hanging off of it than just I'm going to die and somebody's got some money to bury me with, right? So it's kind of morbid to think about, but
it happens.
Yeah, death and taxes, right? It's going to happen.
It's the only insurance policy that I know has one peril. It's guaranteed to pay out.
Oh, okay.
It's the only insurance policy I know that has one peril and is guaranteed to pay.
Eventually.
So
you got this whole life policy.
Mm-hmm.
How long have you had it?
Year and a half.
So you've had this shit. You had this 18 months.
Mm-hmm.
Okay. And what's the value of the policy?
Like the death benefit?
Sure.
So the death benefit is increasing. It starts at like I want to say it's like 600,000 or 700,000, and it will be over 2.5 million at age like 85.
Okay, so you got a $600,000 or $700,000 whole life policy.
Mm-hmm.
You borrowed $40K from it.
Mm-hmm.
How much have you paid into that policy so far?
About 45.
Okay, so you pretty much put the money in and then you borrowed it back.
Mm-hmm.
I love that. You're using the money.
Yeah.
And while you're using it, you're borrowing it at 4% interest, where as an investor, I'm going to go out there and I'm going to buy an investment property. And what am I going to pay in interest right now if I just bought an investment? If I borrowed money from a bank right now, period, what am I going to pay?
I'm going to guess 7%.
7.5% to 8%.
Yeah. You lock in that 4%. You can borrow that at any time. It's locked in for life. So if, say, rates go up to 15%, your fixed rate is going to be 4%. You can also borrow at a variable rate, which is going to be based on I think Moody's, and that's where you'll get your dividends as well, but it's still not going to be as high as you're going to get it from the bank, and you're going to be outdoing whatever interest you have.
And you're paying yourself.
Yeah, you're paying.
You're not paying the bank.
You're outdoing the interest. Like you're going to be earning about 6%, and you're paying it like let's say 5%. You're still earning more money, and you might be only borrowing half of the money that you have in there.
Man, I'm mad. And here's why. It's because I sat down with my financial advisor, and they do sell insurance, life insurance, and I'm sitting there like, guys, I'm in the real estate business. I just need some whole life insurance to cover my family if I die.
Yeah.
Like I'm gonna take my money and I'm gonna invest it in the real estate. I don't need the whole life thing. Like I don't believe in it. I'm not investing in insurance, and I'm not doing that thing. And I walked away like I knew everything. That's why I'm mad.
I was the same way.
That's why I'm mad.
I ain't mad at you. I was the same way because I was like
closed mind, man. I was closed minded.
I did. So you mentioned the Tesla. I ended up putting that money back in. I was gonna just flip it and put it back in. I ended up just paying it back, and I received the rental income and so forth. I could have paid it back with that. Well, when I went and bought the Tesla, I took $43,000 out, and I was able to just go and buy the car. And then I bought the car, and now I have to sell the other one. I can put it back, but it's still earning interest inside of the policy. Something happens, the death benefit. Now, when I plan on retiring at age, whatever it is, let's say 65, I can take loans against that if I never pay it back. I don't pay taxes on it because it's a loan.
There you go.
If I don't pay it back, it comes off the death benefit, which is let's say I'm going to use round numbers. Let's say there's $1 million in cash value. There's a $2 million death benefit. They'll loan me up to 90% of the cash value. So I'll pull out $900,000. Let's say 10 years go by. The interest goes up to $1.4 million. I don't know. I die. My kids get $600,000 income tax free. And then that's it. I don't have to pay taxes on the money that they have.
This is so similar to real estate. And a lot of people, if they watch this, they probably have some interest in real estate, right? Or really good dad jokes. But either way, but the reason I equate this to real estate is like, okay, you put 45 grand into this thing when you started.
Yeah.
It's worth 700 grand if you die.
Yeah.
Okay. So let's start there. Next thing is this is going to increase in value as you own it, kind of like a piece of real estate.
It's true.
And if I went out there and if I invested in a property, let's say that I put X number of dollars into it, I could go out there and borrow against the equity in that property.
That's right.
Right away.
Yep.
And that's how a lot of wealthy people will use assets. Like I would say a whole life policy is an asset because you can use it for gain. And I guess a piece of real estate could be considered an asset, not because it's tangible, because if I go out there and if I have a 4-family apartment building that's worth $500,000 and I owe $200,000 on it, I have $300,000 in equity. I can mortgage that property. I can tap into $200,000 worth of equity in that thing. How much taxes do I pay on the $200,000 that I just borrowed out of my own real estate? Not a damn thing. Now, if I sold that property,
Yep. Capital gains.
if I sold it, now I got to pay capital gains tax if I don't 1031 exchange it into another property, but I don't have to sell it because it's a cash flowing asset right now. So I do the math, I pull the cash out and I say, okay, well, I'm going to take $150,000 or $200,000 out of this thing and I'm going to go buy this thing over here. I didn't have to pay tax on the money that I just borrowed. It's the same thing where you can borrow your own equity, you can borrow your own money, and you're basically just paying yourself back.
Yeah.
Or letting your tenants kind of pay the asset down. So that's why this is so sexy to me, and that's why I'm so pissed off about it. It's like I already do this. It's just with a tangible asset, and this is an intangible asset that is going to pay out at some point in time.
And I think most time what financial advisors will advise against is because it's not a really good investment. It's not like you're gonna lose money, but it is a good tool.
It's a tool in the toolbox. You don't like this isn't for everybody.
No.
It's something that if you understand it, that's where you get your billionaires and your successful entrepreneurs like Robert Kiyosaki. Why was he successful in his real estate ventures? It's because he understood the numbers. He understood what tools were in the toolbox. He didn't use them all.
Yeah.
He just knew what was in the toolbox. And he's like, oh, you know what? This is a hammer, or this is a nail. I've got a hammer. That's a bolt. I've got a wrench. It's like he just knew what was at his disposal. And if you understand this at a better level, it can add so much more. So, you know what I'm going to recommend? I'm going to recommend anybody watching this to reach out to Sean and have coffee or lunch with him, because he, you know, as real estate agents, we get calls from lenders and insurance people all the time, and I've always followed Sean's stuff and found it interesting. So when he reached out and asked to sit down, I'm like, you know what, you kind of read the same books as me. It's like, I want to see what you know.
Yeah.
And I'm really glad that I took the time to sit down and just kind of just see where that went, because I've learned so much more. And as a real estate investor, it's really intriguing. So I'm going to recommend, if you're in the greater Cincinnati area, Northern Kentucky, reach out to Sean. You know, I'm sure he'll be glad to sit down with you for coffee.
Love to.
And chat it out. So what are you reading right now?
It's funny. I was just thinking of some. When you were talking, I was thinking about a quote from one of the books. I think it came from a book called Limitless, which is on increasing your brain power and your learning capacity. And
Yep.
it's you mentioned Mythbusters, and it has like these 9 myths, and one of them is knowledge equals power. And he rephrases it as knowledge times action equals power.
Yeah.
And
you don't
so-
get paid for what you know. You get paid for what you know and apply. That's
And
smart.
one of the hardest things with infinite banking is just actually taking that step and like first understanding it and then taking like, okay, I'm going to make the jump. And that was hard. I got analysis paralysis. Do I do this? Do I do this? Do I put this much? Do I put this much? Do I do this? Do I do that? And like just taking the action.
I'm gonna freeze up.
It's hard. It's really like, okay, I got to just jump in, and knowledge times action equals power. So I think I'll just leave it with that.
Fire, man. I love it. I got a few book recommendations. I won't tell you what I'm reading right now, but the last 3 that I finished, Acres of Diamonds. You read that?
Yeah.
So that one's a good one. And then I was recommended by a friend of mine, Big Money Energy by Ryan Serhant.
Haven't done that.
So he's a $1 million listing New York guy, gray hair guy like me. He looks better and he's a little younger, but he writes a good book. And so I got so into Big Money Energy that I went back and read his older one called Sell It Like Serhant. And he's got some great follow-up tips in there, great mindset stuff. So what was the book that you recommended?
Limitless.
Yep.
Yep.
Awesome. You heard it right here. The Real Estate Momentum Podcast with Aaron Smith. I've had Sean Cohen on today. His contact information will be in there. I tell you what, just in case they don't read the dang notes, how they get in touch with you.
You reach out to me at office 859-694-2284 or call my direct cell 859-443-5566, and email is SCAN, Sean, just like Sean Connery, at S. Cohen Insurance. So it's Sean at scoheninsurance.com.
Awesome. Thanks, guys, for watching. Tune in for the next episode.
See you.